On the macroeconomic front, the coming week features the big double header of jobs and wage data in the UK on Tuesday the 15th and inflation on Wednesday the 16th. Last time around, the Office for National Statistics stated that unemployment in November was 4.1%, just 0.1% higher than it had been before the onset of the pandemic in 2020. Meanwhile, job vacancies surged to a record high. It also noticed that wage growth was 4.2%, and inflation, as measured by the Consumer Price Index for the month after in December, was 5.4%, the fastest rate of increase since spring 1992. Now, two things jump out here. First, the misery index, coined by the economist Arthur Okun, which adds together the unemployment rate to the rate of inflation, that came to 9.2% in November, its highest mark since 2013. And secondly, wage growth barely covered inflation. As a result, real wages and the actual spending power of workers' pay in the shops barely covered price increases. Now, both may help to explain why the Bank of England has squeezed through two consecutive, albeit relatively minor, interest rate increases, and acknowledge that further rate hikes may be on the way as it seeks to rein in inflation. Whether it's leaving it too late, not moving fast enough, or getting it just right is something that only you can decide for yourself. It'll be interesting to see if these trends are starting to weigh on consumer confidence, and that will be the third key macro point of the week. Consultants GfK will release their latest update on Friday the 18th of February. Now, based on this survey, consumer confidence ebbed in each of November, December, and January. Whether that was down to Omicron, inflation, energy prices, or something else is hard to divine, but it will be a concern for politicians and retailers, especially those of big-ticket items. Note the apparent link between consumer confidence and the rate of real, post-inflation wage growth. If confidence starts to sag, so could spending on more discretionary items. Company-wise, the US quarterly reporting season is drawing to a close, but it's in full swing in Europe, just starting to get going here in the UK. A handful of FTSE 100 firms will be releasing full-year results or trading updates, and they and other names to note include the following, although again, please do note some of these dates could yet change. Glencore on Tuesday the 15th, Indivior on Wednesday the 16th, Standard Chartered kicks things off for the banks on the 17th, when Aveva and MoneySupermarket.com will also update their shareholders, and real estate investment trust Segro and Hochschild Mining will then close out the week on Friday the 18th. However, the company which could just cause the biggest fuss in the week ahead, well, that's another bank, NatWest. The parent company of NatWest, Royal Bank of Scotland, Ulster Bank and Coutts is scheduled to release its full-year results on Friday the 18th. The shares have had a cracking run, and they're up by some 40% over the past 12 months, an advance that easily outpaces the FTSE 100 overall. And there are several possible explanations for this. First, the UK economy continues to recover from the impact of the pandemic and lockdowns. Second, as a result of that, NatWest in 2021 has been able to write back some of the loan losses it took in 2020, as things just didn't turn out quite as badly as feared. Those write-backs have boosted 2021 earnings after the write-downs hurt them in 2020. And finally, interest rates are rising. That means bond yields are rising, yield curves are steepening, both trends which could help NatWest's net interest margin and the profit it makes on its loan book. We'll come back to that in a second. To see how all of these trends are fitting to NatWest's operational and financial performance, analysts and investors will turn first to the headline pre-tax profit number. The consensus estimate is £4 billion for the whole year, against 2020's loss of £351 million. Now that does, by the way, imply a fourth quarter profit of just around £400 million, the lowest figure for the year, although that is relatively normal for banks as they tend to clean up and clear out the books in the final 3-month period. To judge the quality as well as the quantity of profit for 2021 and any trends that could feed into 2022, analysts will then dig behind the numbers. They will look at loan and deposit growth, where an acceleration in loan growth would be welcome, the net interest margin on those loans, where the benchmarks are 1.5% recorded in the third quarter of 2021 and the 1.7% made across the whole of last year, And they'll also look at the effect upon the P&L of loan write-backs or write-downs, litigation and restructuring costs. Loan write-backs are expected to reach nearly £900 million where there's a benefit, but conduct costs and restructuring will cost some £1 billion between them, if analysts are correct. If Chief Executive Alison Rose then gives any guidance for 2022, well, the current analyst consensus is for a drop in pre-tax income from £4 to around £3.5 billion, with the big swing factor again being a return to loan losses after the write-backs of 2021. With the announcement from US megabank JP Morgan Chase alongside its fourth quarter figures of a huge step up in investment in IT and digitalisation, analysts and shareholders over here will also be on the lookout for anything similar from NatWest, as higher spending means higher costs, and higher costs can mean lower profits, at least in the short term. Finally, attention will switch to the dividend. NatWest has paid a first half dividend of 3p a share, and analysts are looking for a final payment of 5.7p with a 0.5p special dividend on top to take the total for 2021 to 9.2p a share. The consensus for 2022 is 10.8p, including a 1.6p special, and NatWest is also expected to crank up its share buybacks at a run rate of around £2 billion a year from 2022 onwards. I hope that you and your families are all in good spirits and keeping well. Thank you for watching, and I look forward to seeing you again next week.